This is our discussion of the Chapter 24 homework. And Chapter 24 homework starts on page 790 with some review questions. Those seem to be fairly basic. If you have any questions about them, please let me know. Then we have multiple choice. We did not have any discussion problems. So looking at multiple choice, number 18 first, dealing with contingent liabilities and the review for subsequent events. Well, first, when a contingent liability, something like a lawsuit, is resolved subsequent to the issuance of audited financial statements, which correctly contain disclosure of the contingency in the footnotes based on the information available at the date of issuance. The auditor should, number one, take no action regarding the event. This is simply a normal business event, and if we had to go back and revise all the time for normal business events, we would be doing so all the time. Instead, this will come out in the next set of financial statements. The auditor did nothing wrong, and everything is okay. Then B, which the following would be least likely to be included in a standard inquiry to the client's attorney? And that would be number 2, request for the attorney to opine or give an opinion on the correct accounting treatment associated with an outstanding claim or pending lawsuit outcome. The reason is the attorney is not an accountant, not an expert in that. Then C, an audit report was dual dated for a subsequent event disclosed in the financial statements, which occurred after the completion of the evidence collection process, but before the issuance of the financial statements. The auditor's responsibility for events occurring subsequent to the completion of the evidence collection process it would be number 3, only limited to the specific events referred to. We will not do a search for all events because we are dual dating. So the main audit report would be dated, for example, March 1st, except for these events, which would be dated something like March 10th. Otherwise, if we search for all events, we would single date the report to March 10th. But most clients don't want to do that because it means extra money. Then D, an example of an event occurring in the period between the end of the year being audited and the day of the auditor's report that normally will not require disclosure in the financial statements or auditor's report it would be number 4, decreased sales volume resulting from a general business recession. The reason is it is general and the others are client specific. So the first 3, a reader would only get from reading the client's financial statements. But number 4, someone with general knowledge of what's going on in the economy would know about this. Again, it's not client specific. Then set number 19, concerning communications between management, those charged with governance, and the auditor. So first of all, in A, which of the following is not a required item to be communicated by the auditor to the audit committee or others charged with governance? It would be number 3, recommendations for improving the client's business. By the way, this is something that could go in the management letter, the one that is optional written from the auditor to the client, and that would contain suggestions on how the client can improve its operations. Then B, written management representations obtained by the auditor in connection with the financial statement audit should include number 3, a statement of management's belief that the effects of uncorrected misstatements are not material. That is one of the things that the auditor normally gets management to agree to in the exit conference. Ideally, though, for very important things like this, management should also document those in writing in the client representation letter. That way, we have written proof. Also, please remember that the client representation letter is mandatory. It is written from the client to the auditor on or about the audit report date, so right at the very end. And again, please don't confuse that with the management letter, the one written from the auditor to the client, which is optional. And speaking of the management letter in C, the answer is number 2. It contains recommendations from the auditor designed to help the client improve the efficiency and effectiveness of its business. Then number 20, concerning information accompanying basic financial statements. So everything else which is written up in the annual report outside the financial statements and outside the footnotes. This could include management's discussion and analysis of the financial statements, MD&A. We'll study that more in the second auditing course, by the way. But first, the Form 10-K filed by management of a public company, that's the annual report filed with the SEC, includes a section on management's discussion and analysis, or MD&A, in addition to the annual financial statements. Which following best describes the auditor's responsibility for MD&A? It would be number 3. The auditor must read MD&A to determine if there's any material inconsistency with the audited financial statements. Then B, management of Thurman Corporation included additional supplementary information and documents that include the audited financial statements for the year ending December 31st. Management has asked its audit firm, Wally CPAs, whether they can report on the supplementary information. Which of the following conditions would preclude Wally CPAs from conducting this engagement? And the answer here is going to be number 2, that the supplementary information covers the period from January 1st through February 15th. The reason is this is outside the basic audit report time, outside the fiscal year under audit, in other words. Then C, investment and property schedules are presented for purposes of additional analysis in a document outside the basic financial statements. So there's additional information again. The schedules are not required supplementary information. When the auditor is engaged to report on whether the supplementary information is fairly stated in relation to the audited financial statements as a whole, the measure of materiality is, and it would be number 3, the same as that used in forming an opinion on the basic financial statements taken as a whole. So with supplementary information, that means that we have some additional material here, but we don't relate materiality just to it. It's the same measurement as long as in the financial statements taken as a whole. Now, while I'm recording this, I'm going to go ahead and do the homework from chapter 25. The reason I will is because there are only 2 very short problems about this. And the first one is a review question. It's number 16. We have the Absco Corporation has requested the Herb Germany CPA provide a report to the Northern State Bank as to the existence or non-existence of certain loan conditions. Same thing as debt covenants, things like maintaining certain items of collateral. These conditions to be reported on are the working capital ratio, dividends paid on preferred stock, aging of accounts receivable, and confidence in management. This is Herb's first experience with Absco. Should Herb accept the engagement and substantiate your answer? Whoops, I'm sorry that the book cut, or I should say that the electronic book cut off the very end of that question. Anyway, the answer is that Herb could accept everything except one. That would be the confidence of management. Something that I will get into more in the next course is that the CPA should never evaluate the competence of any other party, including management. Two other things the CPA should never give a conclusion about would be legal conclusion, because the attorney would do that, and the CPA should also never vouch for the achievability of something such as a financial forecast. Then, just one other question, or set of questions, I should say, number 17. Miscellaneous, oops, I'm sorry, that wasn't it. Bear with me just 1 second here. Number 19, whoops. Okay, number 19, let me come on down to it. Concerning reports issued by auditors other than those on historical financial statements. So first of all, we have an auditor's reporting on cash basis financial statements. These statements are best referred to in the opinion of the auditor by which the following descriptions. That would be, in this case, that would be number 1. So cash receipts and disbursements and the assets and liabilities arising from cash transactions. We never want to have GAAP-based report titles for these. And we also want to refer to the basis used, which is cash. Number 2 would be incorrect because financial position, results of operations, refer to the balance sheet and income statement. They are GAAP-based titles. We would not do those. Number 3 also has GAAP-based titles, balance sheet and income statement. Number 4 has a GAAP-based title, cash basis, or cash balance sheet. Balance sheet is a no-no. Then, in B, when asked to perform an audit to express an opinion on one or more specified elements, accounts, or items of a financial statement, the auditor, number 1, may not describe auditing procedures applied. Here's why. We give an audit report on this, rather similar to the basic audit report that we all know, and we don't describe the auditing procedures we did in detail there. Instead, those would be in the working papers. This concludes the homework coverage, and please let me know if you have any questions.